Okay, good day, everyone. I'm just going to kick off by, firstly, I know there's a lot of buzz around the room. I think everybody had a good lunch. I could see that, and all the connections and so forth are being continued. That is very good and encouraging. But let me first of all start by acknowledging the board of the TTCSI, all of the presenters, specially invited guests, all of the members, and all protocols observed. Good afternoon, everyone. I am Colin Ramsey. I'm an associate partner in the tax department of Ernst & Young. I'm accompanied by my colleague Jason Samaru, and we are here today to talk about taxes. And I know that is an area, hopefully, that will pique everyone's interest, especially after having a nice lunch and not allowing yourself to fall asleep. So the purpose of today's session is probably to recap some things that many of you may already know, but I think it's still important to rehash, and also to speak a bit about certain allowances, deductions, and exemptions that are available under the Act. And when I say the Act, I mean the principal tax acts of Trinidad and Tobago. We have seen a reopening of our economy, and we know that businesses are returning to profitable levels. So I guess now is as opportune a time as any to talk about different incentives and allowances that are available to help companies manage their tax liability. So without further ado, I will kick into the presentation. If I could get the clicker to move. Okay, so today's agenda is just going to cover the taxation of companies, the very basics. We're going to go a bit and speak about some legislative updates, particularly as it relates to allowances and so forth that exist under the law. And then we're going to touch a bit on some housekeeping issues. And when I say that, what I mean is compliance-related matters. We have seen over the recent past the Board of Inland Revenue being very active and selecting many of our clients for audit. We've also seen assessment notices being issued to clients where interest has been assessed as a result of short payments and even late payment of taxes. So I think it's important for everyone to be reminded of their obligations and how they go about addressing those obligations. Okay. So generally, companies that are engaged in business in Trinidad are subject to the higher of corporation tax or business levy and green fund levy. Now, corporation tax is levied on chargeable profit. And chargeable profit is really defined as taking all of your income from the various sources under the Act, deducting expenses that are wholly and exclusively incurred in order to produce that income, as well as any allowances which may exist under the Act, which we will cover. You also take into consideration any exemptions that may be available, and we'll touch a bit about that because I know that today's presentation would have looked at cross-border transactions, particularly where export of services or goods take place. And you would probably be very interested to understand what are the implications if a company did cross-border transactions of that nature, provided services in a foreign jurisdiction. What are the implications from a tax perspective? So business levies is akin to a minimum tax. It is levied at a rate of 0.6% on the gross sales or receipts of a company, whilst green fund levy is levied at a rate of 0.3% on the gross sales or receipts of a company. Just to make the point that green fund levy is actually applicable on all income, whether exempt or not, whilst business levy excludes income, which is exempt for corporation tax purposes. There are also specific tax rates applicable to different types of companies, such as companies engaged in the manufacture of petrochemicals and banking entities. They are also subject to tax at the rate of 35%, as opposed to the standard rate of corporation tax of 30%. And then we also have companies engaged in oil and gas activities that are taxed under a specific regime. So generally, companies that are resident in Trinidad and Tobago and residency for tax purposes does not mean incorporation. Residency means where the company is managed and controlled, as evidenced by where the mind and management of the company resides. So what is considered there is where the strategic decisions are made, as evidenced by minutes held to make certain strategic decisions and so forth. And this is particularly important, especially where persons are considering establishing residence for a company in a particular jurisdiction, because we have seen across the territories very similar tests regarding residency for corporation tax purposes. But once a company meets the residency test, it is taxed on its worldwide income, which includes income from foreign sources. So a Trinidad resident company that is exporting goods or services to, let's say, Guyana, which is really a hot topic right now, Suriname, or other territories in the Caribbean region, the income that you earn from those foreign jurisdictions is subject to tax, because as a resident company, you are taxed on your worldwide income. We'll touch a bit on a little later on what relief exists under double tax treaties in order to deal with the avoidance of double taxation. In the case of a non-resident company that is carrying on business in Trinidad, that company is chargeable to tax only on income directly or indirectly accruing in or derived from Trinidad and Tobago. So it is different, as you could tell, where you are non-resident versus a resident company. Okay, so this is a general rule of thumb for all companies operating. You are allowed to deduct expenses which are wholly and exclusively incurred in producing the income from your trade or business. Wholly really refers to the quantum of the amount incurred, whilst exclusively refers to there being no duality of purpose. In other words, the expense must be incurred solely for the purpose of the business in order to meet the deductibility criteria under the Act. So specific expenses are addressed under the law, and we'll just touch on a few of them. So for example, entertainment, where you entertain customers of the business, the amount that is deductible is capped at 75% of the expenses incurred in entertaining those customers. All right. So again, where you have bad debts, you may have provided a service and not get paid in a timely manner. So there is a provision for bad debts. I know the accounting standards have new or revised, updated criteria around provisioning for bad debts. But from a tax perspective, the rules remain the same in that only specific provisions for bad debts are deductible. And in the case of bad debts written off, you must prove to the satisfaction of the board that all attempts were made to recover the debts owed. Okay? From a provisioning perspective, what the BR looks at is whether the amount provided for is reliably estimated, as shown by whatever methodologies applied in order to arrive at the provision for bad debts. A simple percentage applied by sales, which is more in the nature of a general provision, would not cut it, unfortunately. So donations. Generally, donations to charity or any other body are not deductible for tax purposes unless they meet very specific conditions. So donations made under deed of covenant to specified entities. So we have here a list: ecclesiastical, charitable, or educational institutions, and then sporting body of persons. They also amended it to include donations under the Children Life Fund and so forth, would be deductible insofar as they are made under deed of covenant. And then there is also a restriction on how much you are allowed to deduct, which is capped at 15% of the total income for the year. Now, one may think that total income means gross income, and on the face of it, it really appears to be that way. But tax, like I'm sure you would have realized by now it's not as straightforward as that. And when you look at the definition of total income, it actually is very similar to chargeable income because it actually backs out from it exempt income, and it allows you to remove from the calculation expenses wholly and exclusively incurred and so forth. So 15% of chargeable profit would be the limit you are allowed to deduct for donations. Interest, in case of borrowings, companies are allowed to deduct interest expenses where the purpose of the proceeds of the loan were used in the trade or business. Also, the interest must be paid, and the recipient of the interest must either be chargeable to tax or exempt under specific regime. Now, where you pay interest to a non-resident entity, the issue of withholding tax comes into play. In fact, any payment that is made to a non-resident, immediately a trigger should come to mind to ascertain whether withholding tax is applicable. And just to make the point that withholding tax is applicable on payments or distributions made to non-residents of Trinidad and Tobago. Okay, and then the last point is that the interest must not be recharacterized as a distribution. But that really contemplates where you are paying interest on non-resident parent company on a securitized type transaction. Ordinarily, if you're paying interest to a local company, that issue ought not to come into play. All right? So and the last point is really, if you pay interest on late payment of taxes, that is not deductible for tax purposes. Okay? So under the Act, you are also entitled to claim wear and tear allowance on plant and machinery and equipment used in your trade or business. The basis on which you calculate capital allowances is actually the cost incurred in acquiring the plant and machinery or capital expenditure incurred in the construction of a building or structure. And we have here cost includes the cost of installing machines or the cost of adapting any building, which contains, example, strengthening of floors and so forth, right? So also, where you dispose of an asset, what you do is you deduct the proceeds from disposal from the wear and tear pool. In Trinidad and Tobago, we have what is called a pooling concept for wear and tear purposes. So assets go into a pool and they lose their individual identity. There are different classes which exist under the Income Tax Act. As you would see here, you have Class A, which is really buildings or capital improvements made to a building or structure. Class B, which generally includes the majority of assets, plant and machinery, motor vehicles, vessels, and so forth. Class C, which includes more heavy type equipment, forklifts, bulldozers, also computers fall under Class C, and Class D really deals with second-hand aircraft. These rates are applied to the particular pool or class that the asset falls into. And you will see 30% being illustrated for Class B assets. One thing we noted during our tax return filing period, which just ended April 30th, well, it was extended to the 2nd of May because the 30th fell on a holiday, on a Saturday, and the Monday was the holiday as well. What we realized is a lot of clients applied the old rate, the 25% rate, and so they overpaid taxes because during the period, they would have obviously budgeted based on that lower wear and tear rate. So just to make the point that any assets that are in Class B now attract a slightly higher rate, this is one of the changes that came into effect in one of the recent finance acts, as we'll touch a little later on. Okay, so this is just a recap on the disposal that we spoke about. So where you dispose of an asset, you deduct the sales proceeds from disposal. In the case of loss or destruction of plant and machinery, the amount received by way of insurance proceeds is deducted from the pool. Again, the Act has anti-avoidance measures in place which deal with transactions between related parties. So where the buyer and seller are associates, as defined under the Companies Act, then the amount that the asset is deemed to be disposed at is the market value. And then in any other event resulting in the cessation of plant and machinery, the amount that is applied is the market value in working out the wear and tear allowance in the pool. So we're going to touch a bit on promotional allowance, and this is particularly important for companies who are looking at exporting to foreign markets. And as mentioned, the Corporation Tax Act provides for promotional allowance of 150% of the expenditure incurred in creating or promoting the expansion of foreign markets for the export of certain specified services, as well as goods and agricultural produce manufactured or produced in Trinidad and Tobago. Now, previously, these exports should be to non-CARICOM territories in order for this promotional allowance to apply. So the whole idea is you get a step up on the expenditure you incur to promote the export of goods and certain specified services, where you export as a result of that spend, you export goods or services as the case may be. Now, effective 2020 Finance Act, the first-time exports to CARICOM territories are now included as part of the eligible expenditure for promotional allowance. So this is only applicable to first-time exports to CARICOM, but not on an ongoing basis, okay? So just a few other points. The allowance is in respect of the export of goods and certain services, and the services are shown there: architectural, engineering, design, quantity surveying, contracting services in the building industry, and so forth. And in order to benefit from the allowance, the expenses incurred must create or promote the expansion of foreign markets, including CARICOM markets, and must be in respect of those services that I mentioned. Another important point to note is, and you will see this in the other slides that I'm about to cover, this allowance actually does not have a cap in terms of how much you can deduct. So basically, once you qualify, you claim the 150% uplift on the expenditure incurred. So this is one hopefully everybody's familiar with, where you incur costs in the training and retraining of your employees. You are able to benefit from a 150% uplift on the costs incurred in training and retraining employees. Now, people have asked, what is training for the purpose of claiming this allowance, and what type of costs are covered? Well, there is no definition of what constitutes training expenditure under the Act, unfortunately. But we believe that once you can show there's a nexus between the training conducted and the business of the particular entity or the particular roles and responsibilities of the persons who are being trained and their functions, you should qualify for the allowance. We also believe that if you send persons on overseas training, the cost of travel as well as other related incidental costs to conduct the training should also qualify for the step-up. So under the Act, if any company incurs a tax loss, it is allowed to carry forward those losses indefinitely. Now, under the Petroleum Taxes Act, there is a limit in terms of how much loss relief may be applied to profits generated in subsequent years. For the purpose of ordinary companies, though, there is no such limit. So you carry forward your losses, and you could apply it against profits in subsequent years. So just going on to some legislative updates. So, So if you made a profit and in a subsequent year made a loss, if you could... Oh, yeah, you definitely could. The claimant of the allowances is not impacted by whether you're in a profitable or loss position. These allowances are entitlements under the Act. Whether you are in a profitable or a loss-making position, you are still eligible to claim the particular allowances. Now, Trinidad doesn't have transfer pricing law currently, but there is anti-avoidance law, where the tax authority is empowered to challenge expenses claimed or transactions which they consider artificial or fictitious in nature. So if a company is making losses and it appears to them that the expenditure incurred seems a bit excessive, if you're making losses, why are you spending all of this money on this, right? They may question the business reason for taking those decisions. But certainly, once you incur the costs, you would be entitled to claim the allowances. You raise a point there that actually I should also mention, it's not covered in the slides, but for those of you who have group companies, which are 100% group companies, there is also group loss relief that is available under the Act. There are very specific conditions to be met, but just understand that for group loss relief to be claimed, the entities must be Trinidad resident companies, and they must be part of a 100% group. Okay? So these are some amendments that recently came into effect from the Finance Act 2020 and 2021. So introduction of an allowance of 150% of the expenditure incurred up to a maximum of $3 million in respect of investments in a tech startup or new tech business, engaging in technology solutions and digitization, and creating employment in a technology industry where the employees comprise a majority of persons between the ages of 18 and 35 years of age. I think this is a very interesting incentive that was introduced in law by way of the Finance Act that we would have mentioned, right? And we have seen clients obviously express interest in looking at these incentives. So just to make the point that where you make investments in a tech startup or new tech business, and you hire people like new employees for creating employment in the technology industry or engage in technology solutions, you get a 150% of the expenditure you incur on any one of those capped at $3 million. Okay? The wear and tear allowance, I think we covered. So with effect from January 1, 2021, the applicable rate of wear and tear increased to 30% for assets listed in Class B, was previously 25%. So allowances for creative and sporting industries, effective 1 January 2021, the maximum amount a company is allowed to deduct on expenditure incurred in creating or promoting sportsmen or sporting activities, art and culture takes different forms when you look at it under the Act. There is performing art, and then there is visual art, where work is done by a national of Trinidad and Tobago. And companies who are involved in audio and visual and video productions for the domestic market, or in the fashion industry, expenditure incurred to promote the fashion industry, you get a maximum amount deductible of $12 million. It was previously $6 million, but the threshold was doubled so that you get a tax write-off of up to $12 million on any expenditure you incur in relation to the expenditure incurred in promoting any of these industries. Okay. Now, just to make the point that when you claim, if you incur the expenditure on each one, collectively they are capped at $12 million. So you can get $12 million for each one. It would be in total. Okay. So for SMEs listed on the junior stock market, they have some pretty good incentives that are available for those entities. And if companies are interested in being listed, this is something that you would want to hear. So prior to January 2021, SMEs that were listed on the TTSE were subject to corp tax at the rate of 10% for the first 5 years from listing, and thereafter they were subject to tax at the standard rate of tax. With effect from January 2021, newly listed SMEs are now subject to corporation tax as follows: a full exemption from corporation tax for the first 5 years from listing, and subject to tax at the rate of 15% for the next 5 years. Now, the Finance Act 2021, which actually takes effect from January 2022, made further amendments to further incentivize companies that are listed on the junior stock exchange. So instead of being subject to tax at the rate of 15% for years 6 to 10, the listed SMEs shall now be subject to tax at 50% of the standard rate of corporation tax during that period. Well, coincidentally, as of now, if you are subject to tax at the rate of 30%, which is the general rate applicable to companies, that works out to 15%. But then again, we don't know in the next few years whether that rate would hold, increase, or decrease, as the case may be. Listed SMEs shall also be liable to business levy at the rate of 0% for the first 5 years and 50% of the standard rate of business levy for the next 5 years. And as I mentioned at the beginning of the conversation, 0.6%, 0.6% on your gross receipts is the applicable rate for business levy. Listed SMEs shall be liable to green fund levy at the rate of 0% for the first 5 years, and again at half, 50% of the standard rate of green fund levy for the next 5 years. The current rate of green fund levy is 0.3%, and again that is levied on your gross receipts. So these are incentives that are there to incentivize companies who are desirous of becoming listed on the Trinidad and Tobago stock exchange, right? Particularly SMEs. And these are some of the qualifying criteria in order to be eligible for that. Following the initial public offering, the minimum issued share capital is 5 million, while the maximum issued share capital must not exceed 50 million. The minimum and maximum capital base comprises only of issued share capital and does not include retained earnings and accounts transferred from such issued share capital or retained earnings to reserved account. There must be a minimum of 25 unconnected shareholders who own a total of at least 30% of the new issued share capital of the company. And lastly, the capital is raised by way of the issuance of an initial public offering followed by a listing on the TTSC no more than 60 days after the allotment of the issue. Okay? So we have some incentives for manufacturers. So again, under the Finance Act 2021, companies, and also by way of which takes effect 2022, and 2023, companies engaged in manufacturing, with the exception of petrochemical companies, shall be subject to corp tax at the rate of 25% on the first $100,000 expended on projects related to information technology, digitization, or technology development to advance growth in the manufacturing industry. So you must be a manufacturer in order to qualify for this incentive. And you must also show that the amount expended is geared toward information technology, digitization, or technology development. Now, what we pointed out here at the bottom is it's quite interesting because when one looks at incentives that are available under the Act that speak to reductions in tax rates, it is normally linked to chargeable profit. Remember, we started off by saying companies are subject to tax on their chargeable profits, which is really your income from all sources, less expenses wholly and exclusively, less allowances, wear and tear allowance, promotional allowance, all these allowances that we are going through in order to arrive at that chargeable profit position. Interestingly, this provision speaks to expenditure incurred. So it's not something we have seen companies actually take advantage of. In fact, it only came into effect from January of this year. So in time to come, hopefully clarity will be obtained on this particular incentive. So there is also a reduced rate of corporation tax for companies engaged in technology solutions and digitization. So a company whose core business activity is technology solution or digitization shall be subject to tax at 50% of the standard rate of corporation tax on the first 100,000 of chargeable income for the income year 2022, and then on the first 200,000 of chargeable income for the income year 2023. So as you could tell, this incentive has a very short window to take advantage. You have income years 2022 and 2023 from which you could benefit from the allowances in that regard. And then from January 2021, computers were traditionally zero-rated, but the list of zero-rated items expanded to include peripherals and other computer-related software and so forth, tablets and all mobile devices and so forth, so that the rate of VAT now on the importation of these items is actually 0%. Also, the online purchase tax, which was introduced by the government, would not apply on the importation of these items. Okay, so there is also a research and development allowance that was introduced under the Act, where a company incurs expenditure engaging in research and development. It shall be entitled in computing its chargeable profits to an allowance equal to 40% of the actual expenditure incurred up to a maximum of $3 million. Research and development is defined to mean a process intended to create a new or improved product. And then from a foreign investment perspective, in an effort to encourage further foreign investment, the rate of withholding tax applicable on distributions made to non-resident companies reduced. So previously, where you made a distribution to a non-resident parent company, the rate was 5%. Now that rate is reduced to 3%. And where you make distributions to companies other than a parent company, non-resident companies, the rate was 10%, that reduced to 8%. And distributions are defined in the Act to mean like after-tax remittances, so like dividends and so forth is what we're referring to here. Okay. So again, electric motor vehicles with effect from January 2022, there was a removal of customs duty, VAT, and motor vehicle tax on new electric motor vehicles imported for private use, and on used motor vehicles imported for private use, which is not older than 2 years from the date of the year of manufacture. And there's a definition of what an electric motor vehicle is here, so that you could look into this further. Okay. So, CARICOM income. So, where services are exported from Trinidad to any member in CARICOM, there may be relief available under the CARICOM Double Tax Treaty. Now, the CARICOM Double Tax Treaty is a multilateral treaty which comprises several member states. Barbados is there, Trinidad, Guyana is there, Jamaica. Suriname, unfortunately, is not a signatory currently to the CARICOM Treaty, right? But where you fall within the CARICOM Treaty provisions, it provides exclusive taxing rights to the jurisdiction where the income arises. So if the work is done, let's say, in Guyana, you provide services, and Guyana taxes that income, whether through the imposition of withholding tax on the money you receive back in Trinidad, or whether you set up an entity in Guyana and subject to corporation tax on that income in Guyana. As a Trinidad resident company, assuming you formed a branch in Guyana, you would have an obligation to report that income as well for corporation tax purposes in Trinidad. And in an effort to avoid double taxation, the CARICOM Treaty gives the exclusive taxing rights to the jurisdiction where the income arises, which would be Guyana in this instance. So that means when you report that income for tax purposes in Trinidad, it suffers no further tax. You treat it as exempt income or non-taxable income, as the case may be. Okay. Also, to make the point that under the Act, business levy is applicable, as I mentioned, on gross sales or receipts, excluding income which is exempt for corporation tax purposes. So what that means by extension is that the CARICOM income would not be subject to business levy. However, Green Fund levy would apply on the CARICOM income. That is really the only levy that you would have outside of the taxation that you suffer in the particular jurisdiction, as the case may be. Okay? So this is just some very important but housekeeping matters. So companies that are operating in Trinidad have an obligation to pay taxes on a quarterly basis. How you determine the quarterly taxes is you would normally take your chargeable profits from the preceding year of income multiplied by the current year's tax rate and divide that by 4. And that is what you would normally remit by way of quarterly installments. Now, the Act states that where you expect your chargeable profits to be higher than the preceding year of income, you are required to pay by December 31st the sum of the prior year's tax liability plus 80% of the increase in the current year's tax liability over the prior year. Conversely, if you expect your chargeable profit to be lower than the preceding year, you should not unilaterally decide to pay a lower installment based on the reduced chargeable profit. What should happen is you should write to the Board of Inland Revenue and request approval to pay a reduced corporation tax installment. Now, I will tell you practically, we have done that in the recent past, and we have not received responses from the Board of Inland Revenue. It's unfortunate, but it is what we deal with at this point in time. So when that happens, you then have to make a call. Do I go ahead and pay on the reduced installment without the approval of the board, or do I pay on the prior year and risk overpaying my taxes? And we all know, I think, or have an appreciation of how long it may take to get a refund back from the Board of Inland Revenue. So that is really, it boils down to a commercial decision at that point, but this is really just to remind you of your obligations to pay the quarterly installments. Apart from corporation tax, you would also have to pay Green Fund levy on a quarterly basis. As I mentioned, Green Fund levy is applicable at the rate of 0.3% on the gross sales or receipts of the company. Now, the Act prescribes that if the amount you pay is less than 90% of the actual Green Fund levy liability, the board may assess you to interest. So remember, your quarterlies are current, right? So the quarters are March 31st, June 30th, September 30th, December 31st. Because the installment falls on the last day of the quarter, there is some level of estimation involved, because you may not have all the information available at hand to be able to determine with certainty what your gross receipts or income for that particular quarter amounts to. So the board recognizes that, and the Act makes provisions for that. But all they're saying is make sure that whatever you estimate amounts to at least 90% of what the actual turns out to be, or else you could be penalized interest for that short payment in Green Fund levy. Business levy works identically in terms of how you work out the installment. But just to remind you that a company should only pay the higher of corporation tax or business levy and not both, okay? So from a tax return filing perspective, companies are required to file their returns by April 30th of the year following the year of income in question. There is an automatic extension granted under the Act, which takes that date to October 31st. Failure to file the return by October 31st of the following year of income may result, or would result, in a late filing penalty of $1,030 for every 6-month period or part thereof that the return remains outstanding. If you have a balance of tax payment to make, you should also do that by April 30th to avoid being penalized interest on late payments. Okay? And that's it. Don't know if anyone has any questions they would like answered at this point in time. Yeah, sure. Right. So your client is not from Trinidad. Yeah. They're outside, right? But you perform the work in Trinidad? Right. So that's a very good question. Thanks for asking that. So VAT is applicable on the commercial supply of goods and prescribed services in Trinidad and Tobago. The standard rate of VAT currently is 12.5%, except in the case of a supply which is zero rated. Now, under Schedule 2 of the VAT Act, there's a wide range of zero rated items. And included therein is a specific provision that deals with that situation you described. What it says is where services are supplied to a recipient who is not within Trinidad at the time the services are performed, the supply shall be regarded as zero rated. So in other words, you charge VAT at 0%. Yeah. I originally had VAT in this slide deck, but I figured it may have been too much to cover. We were just allotted half an hour to conduct this presentation, so yeah. That's a very good question. So just to make the point that recently, Suriname proposed some tax changes and was intending to introduce withholding tax on services, which is something that doesn't currently exist in Suriname. Now, when that proposal was made, it is my understanding that conversations were held by members of both, like CARICOM jurisdictions and the government of Suriname on the importance of having Suriname be part of the CARICOM Treaty, because of course, where you are not party to the CARICOM Treaty, you don't get that relief that I spoke about where the income is only taxed in one jurisdiction. Instead, what you get is what you call unilateral relief, which effectively amounts to 1/4 of the taxes suffered, well, the Trinidad and Tobago taxes on that foreign source income. Whereas a Commonwealth country, the relief is 1/2, well, 50% of the taxes suffered. I think it's something that is a topical issue, so I think I wouldn't be surprised if that is amended in the near future. Good question. I think there are probably a handful or so, not too much, and I think these revised incentives were actually intended to increase that number of companies that are listed on the junior stock exchange. But you're right, there are not that many currently, from what we understand. Yeah. Sure, no problem. So, business levy is akin to minimum tax. So typically, you would only see business levy being applicable where, one, the company is in a tax loss position, or two, the profits are so compressed that when you take the 0.6% of the gross receipt, it works out to more than the 30% corporation tax on the chargeable profit. Companies are not required to pay both. It is really the higher of the two. In fact, when you prepare a corporation tax return form, on the summary page of the taxes, you will see corporation tax liability, business levy liability, higher of corporation tax or business levy liability, and that would be your final liability. Now, I want to make the point that if you made business levy installments, quarterly installments, and you end up in a corporation tax position, the quarterlies paid would be allowed to offset against your corporation tax liability, and vice versa. If you paid business levy and you end up in a corporation, or corporation tax installments and end up in a business levy, you get the offset of the, you had a question as well? Right. So remember the incentive for the sporting allowance, and just to elaborate a bit on that, is expenditure incurred in the promotion or expansion of sporting activities or sportsmen. And the definition of sporting activities includes specific sports. basketball, football, cricket, and so forth. I can't remember seeing horse racing for any horse racing enthusiasts in the room, but there are specific sports that are covered. Now, this is really intended where you incur expenditure to promote that sporting activity or sports person. So this is more from the perspective of the company that is spending the money to promote the particular activity. But once you do, there is no criteria under the Act that I could recall seeing where you have to get approval from the Ministry of Sport to claim the allowance. It doesn't work like that. Once you could show that, look, I contributed money toward this sporting activity and I classify it as such, you get to claim the allowance for that spend. Yeah, I would say if you have a sporting company and you incur the expenditure, remember, is one of the two it would qualify. What sporting activity are you promoting? If you're a sporting company held like an event, a small goal tournament, and your company is a sponsor of that, to me that qualifies. But just making a donation to a sporting company, that might be a little bit of a push because you're not technically promoting a sports person or a sporting activity through a donation to a sporting company unless you could show the link between what the sporting company is doing and the particular claim. That's a very good question. I was actually looking out for that one. The Act is not clear. That's the short answer. We have looked at that in some detail, and we believe that the intention is to really cover companies who are tech companies, not a regular company engaging in a tech solution. And the reason I say that, I don't know if these slides would allow me to go back, but the reason I say that is because, let me just show you one thing when I go back here. Right, so if you read here, introduction of allowance of 150% of the expenditure actually incurred up to $3 million in respect of investments in engaging in technology solutions and digitization. It almost suggests that the entity must be engaged in the business of technology solutions and digitization in order to benefit from the allowance. And I think clarity should be given, but the reality is, I mean, that's the beauty of tax. It's not always clear-cut. It depends on interpretation, but certainly that is how we see it. But it's certainly up for debate. Qualifies. Well, yeah. So normally, when a company is claiming an allowance or deduction for tax purposes, there should be a nexus between some profit-generating activity and the spend. But I think to her question, what she was asking is if, so for example, in your line of business, Stuart, whether you would qualify for that allowance. And the question is, are you a tech company? And if the answer is no, then you may not. Because the way it is worded is it's not clear. We believe, based on the wording, it only covers tech companies. That, and I think that is where the intention is. So that if you want to do that, you could form a company, and the articles and all the other instruments governing that company would show that this is a technology company that you are setting up for the purpose of engaging in digitization. Then all of these allowances, because when you invest in this new tech startup business, you also get the uplift. If you hire people to work for that tech company, you also get this allowances step up. And then any other expenditure incurred in investing in the technology solution. So it's 3 various activities that you're allowed to claim a step up for. Yes, because to me that puts you into that tech company because you are developing software for a customer now. So I think you now move into that sphere of being a tech entity. So I think yes, if you develop for a client, yeah, correct. So then that yeah, so correct. So that could move you into. Sorry, you had a question. Yeah. Yeah. I think it could qualify. The only thing is, I think the Act makes reference to what is like a new tech business. No, we don't have it on the slide. So what I think is the company must be incorporated on or after January 2020 in order to be deemed to be a new tech business. If the company was in existence before, then any investments into the company may not qualify. Mm-hmm. A new business? Well, yeah, I mean, if you could show that it is a technology company and you invest in technology solutions and digitization, I think you should be able to qualify for the allowance, the step up. And also, if you create new employment, particularly for the persons within this age group, 18 to 35 years of age, because this incentive was really intended to cover or to promote the hiring of youth in technology. So that is why the age limit is so defined, right? And if you could show that this company, even though it was in existence, is now investing further through creating employment and engaging in technology and technology solutions, then I would think it should qualify. But it's a good question. It's definitely something to explore further. Thanks so much for that that marketing moment. Yes, I mean, yeah. And this is the point of the presentation. I don't think many people in the room would like read tax in their spare time or practice tax, and it doesn't come naturally to everybody, you know. And you know, for us, it's all about imparting knowledge and really making people aware that these incentives exist. These are things you could look at. Something as simple as the change in the corp tax, the wear and tear rate for Class B assets. Many people miss that. And they didn't realize, well, hey, you know, I got a more wear and tear allowance from 2021 income year. So definitely, what I will do is I will probably leave some business cards. And if anybody wants to reach out to me directly, or Jason, as the case may be, certainly we'll be happy to have a conversation and take it further. All right, well, thank you for your time and your attention, and I hope that you enjoy the rest of your evening.